Hello and welcome to Advanced Projections March 2021 Economic Update. Here's our review of our forecast from last month. Since our last report, we have seen U.S. political drama decline substantially, and the new administration moves forward with its initial agenda, most prominently consisting of a solid and proactive program of slowing down and then eventually eliminating the consequences of COVID. Vaccine doses are currently in much wider distribution nationwide, and full inoculations have now reached 10% of the U.S. population. As of today, March 10th, the new and substantive stimulus is now approved by both the House and Senate, and a presidential signature is expected by the end of the week. Extension of unemployment benefits through the entire summer, as well as substantive payments to the bottom income half of the population, are designed to add impetus to the economic recovery. As we said in our last 4 months' reports, Recession 2020 has technically ended. There have been clear improvements in expectations for better days ahead, accompanied by continuing rampant speculative excesses in the equities markets, as well as elsewhere, such as in cryptocurrencies and some precious metals. Real estate prices have advanced sharply in upper-end housing. Margin borrowing again hit a new record high in January and is sure to have climbed even more since then. The party in equities continues, and we're pretty sure most of the partiers are now fully inebriated but will continue to imbibe. There is nothing visible on the horizon that would pierce the equities bubbles, but caution is still warranted in taking positions in markets which are outrageously risky from valuation standpoints. We have an eye-opening chart further down in this report. Now, for the underlying socioeconomic situation. We said last month that our expectations for COVID cases and fatality tolls would continue increasing for many months into 2021. As of now, March 10th, 2021, U.S. cases reached 29.2 million, an increase of 2 million in the past month, down as compared to an increase of 5.2 million in the previous month. New cases have declined by approximately 2/3 in just the past month, from over 220,000 per day to less than 70,000 per day. U.S. fatalities have reached past 541,000, up approximately 75,000 in the past month. If we use the reliable ratio of total fatalities divided by total resolved cases, the fatality rate is about 2.6%, approximately a 10% decline in that grim statistic since the beginning of the year. But this rate has not changed in recent weeks. The number of people who are dubiously titled long haulers, those with persistent post-critical infection symptoms and issues, continues to increase and will add to the burdens already placed on the nation's healthcare system. We are now past our third wave, as new case and fatality numbers have dropped substantially from January's peaks, but we are still at the top of both the total cases and total fatalities lists. In spite of having only 5% of the global population, we still have more than 25% of the global cases and 20% of the global fatalities. Incremental improvements are good to see, and perhaps the mass psychology is now embracing more vigilance as vaccinations are at least on the horizon for most of the high-risk population. As of this writing, nearly 10% of the U.S. population has received 2 doses of vaccine, and vaccination rates are moving up past 16%. Many states are now engaged in vaccinating those age 50 and over, as well as members of other high-risk groups or essential occupations. However, more highly transmissive strains were identified as incoming from Great Britain, Brazil, and South Africa. Cases of those forms appeared in the U.S. as early as November of last year, and now continue to appear in increasing numbers across much of the country. These variants still threaten the U.S. with yet another wave, which we feel will materialize as they are more contagious, and we are entering the spring break season, where millions of young people will still engage each other at close quarters, and most without regard for the still necessary safety protocols. So that wave of new cases, should it materialize, will begin around the beginning of April and could last for 4 to 8 weeks. We'll have to rely on vaccines to keep ahead of this curve so that instances of severe cases and fatalities do not grow as much as in the just ended third wave. Globally, cases have reached 118 million, up about 11 million in the past month. At this moment, there are still over 420,000 new cases being reported daily. Global fatalities have now solidly reached past 2.63 million and will likely reach nearly 3 million by the end of March. Vaccine test results and slowly increasing deployments have added to a growing national optimism. However, it would still be optimistic to presume that under the best of circumstances, it will be at least the end of first quarter or later before large numbers, i.e. several tens of millions of people, will be given doses of one of the 3 vaccines currently approved or still under trial, and that it will be much later in 2021 for a fully implemented national vaccination program. Convincing enough people to get the vaccination will come into play. The early adopters of this are those who have been most at risk, the essential workers and the elderly. We expect this to continue until all the willing in the 50-plus age category have had their demand filled. So perhaps 100 million of Americans overall, 30% of the total population, will be ready and willing to receive one of the vaccines, leaving 230 million as fertile territory for keeping the pandemic active. As of this writing, about 58 million, 16%, have received their first dose of vaccine, reflecting first dose rates of about 1 million per day. We are expecting continuing improvements now in rollouts and mass vaccination efforts. The goal is to eventually have 90% of the population vaccinated, but even 75%, if achieved, is enough to end the most serious threats, assuming the most vulnerable portion of the population achieves vaccination rates well into the 90s percentages. Other vaccines have yet to be approved, but when that happens, we may be able to reach 25% of the population, about 80 million people, by early spring. A useful figure for achieving widespread control of the pandemic is having at least 60% of the population vaccinated and much greater compliance to actually eradicate it. 60% coverage would mean acquiring and distributing 400 million doses. Doing this 24/7 for 2.5 million doses per day still means 4 to 5 more months. Still not an easy program to undertake and meet the challenge of actually attaining the necessary compliance numbers. We are just now catching up to the promised vaccination rates, and after seeing continuing and significant improvements during late January and February. A curve we have been using since it was created on November 20th last year and have been modifying periodically shows the danger in letting the pandemic resume its havoc. We are still running above this original projection in terms of actual fatalities versus the model. So we'll have to wait and see for another couple of months if the problem is truly being solved, as would be evidenced by actual fatalities declining below the model's curve. We updated this chart on March 1st of this year, essentially the first anniversary of the first COVID fatality in the US on February 29th, 2020. At that time, fatalities were substantially above the projections made just 100 days before, up 16% over the projected one-year total of 440,000. We are still waiting for the data to show that we are headed in a direction pointing below this curve, and would like to see that happen in the next 60 days. If it does not, 2021 is going to end where many of us is not going to end where many of us would like it to. Now, the current economic environment. In February, unemployment levels moved down moderately to a national level of 6.2% after a monthly gain of nearly 380,000 jobs. As we have been anticipating for several months, return to work gains have flattened well below a full recovery level. That is clearly illustrated in the following chart, courtesy of the New York Times, based upon U.S. Labor Bureau of Statistics, dated through February 5th. Adding in the gains during February, we still have 9.5 million jobs lost in the past year. Our view is that this flat spot will last for several more months, and then job gains will begin to return much more slowly, taking 18 to 24 months more to erase essentially all of the remaining job losses created by the pandemic. Many of those jobs are now permanently gone, and newly created ones will be required to fill in the gap, presenting a challenge to the current administration and Congress to move forward beyond rescue and into recovery planning. Equities markets have continued to power ahead, with more volatility getting ever deeper into bubble territory. There are now increasing warnings being put out in the financial press as well as by indicators utilized by investment bankers that warn of a corrective environment that has formed for equities. We still concur, but cannot really say exactly when the new market highs will stop forming. Fourth quarter of 2020 and annual corporate earnings reports have been coming out over the past 2 months with little evidence of systemic weakness. It is likely that fourth quarter year-over-year total earnings for the S&P 500 could be up about 1.5%, which is strong given the circumstances, but is hardly anywhere near the amount that would justify the leap in equities prices over that same one-year period. Strong fourth quarter performances occurred in the financial, IT, and communication sectors, and the continuing weaknesses in energy, industry and manufacturing, and hospitality can only improve slowly from here. One area of improvement that is now trending upward is air travel passenger miles. Newly vaccinated seniors are eager to visit distant family and friends and are reserving millions of tickets as we write. Now for our individual indicator information. Our APSI stock indicator looks at months-end S&P 500 equity closes, comparisons to a set of long-term growth rates, and to the GDP itself. A few months ago, we published twice about the three indicators we use to establish whether the markets have entered bubble territory. Now, new highs have been occurring rather consistently within the past several weeks. In spite of fourth quarter earnings improving a bit more than initially expected, the PE ratio of the S&P 500 continues to rapidly increase further, beyond a doubling of where it should be under normal circumstances. If this index were to remain absolutely flat at today's nominally 3,900, the index's annual corporate earnings would have to increase year over year by roughly 25% for 3 years straight, just to get back to realistic index valuations with a trailing PE of less than 20. We continue watching market performance and growing margin borrowing levels, which is our favorite tool for tracking speculative excesses. The last peaks in margin borrowing showed up before the two large corrections of 2018, both of which we predicted. During Recession 2020, margin debt actually increased by nearly 50%, absolutely flying in the face of the consequences of a recession and ignoring realistic prospects for the economy going forward. From a $665 billion level in October of last year, margin debt was a mere $35 billion away from its all-time high of $700 billion set at the end of 2017. And that's about where it was when we warned of the first market correction of 2018. During November of last year, margin borrowing penetrated those record levels and is now at historic highs, with the last reported level at $790 billion, as it increased $50 billion in December and $40 billion plus in January. Circumstances are vastly different from 2018's interest rate environment, but heavy margin borrowing that is synchronizing with markets making significant new highs is a likely driver for a market correction beginning, quote, soon, unquote. Last time we said this, the correction began within 3 months, and it came in 2 waves during 2018. The latest information on margin debt is from January of this year, shown in a fresh chart below from Advisor Perspectives. We expected to see further large increases in this during January, which did materialize, and surely February and March will also show increases. Under similar circumstances seen in this chart, 2 blue index drops of 50% of real value followed shortly after each major correction began. A similar size drop now in the S&P 500 index would take us to well below 2,000. February's closing value for the S&P 500 keeps our APSI indication as solidly red, with that index moving even further into blatantly overheated territory after a small correction in the first week of March. Another primary indication of the top-heavy nature in equities is the spread between the S&P 500 and the metric representing 10% of the GDP. We use this as our chart where we can overlay those two indices. This gap continues to grow as shown in our third chart. We see this as an indication that more and more of our GDP is being tied up in speculative activities rather than in solidly productive activities, those being goods and services. This is our form of what is more widely considered to be the Buffett indicator, and the upper smooth curve is the boundary between a warm market and a hot bubble zone. Now, we also provide in our report an additional chart courtesy of Advisor Perspectives. It literally shouts out how risky the U.S. equities markets are using a set of 4 indicators very similar to our own in philosophy. This is in bold red in our report. The risks now are at all-time highs. Our other AP indicator status is as follows. The AP MS money supply indicator remains solidly green as the Fed continues with their expansion of the money supply. Having now reached $19.4 trillion, up 23% since the beginning of 2020. It has also continued to warn Congress that the bottom layers of the economy are still suffering, and the whole economy will suffer lackluster growth if no new and significant stimulus were to be injected there. Additional stimulus had been dangling in front of us many weeks. Negotiations on further stimulus have now concluded, and we have a solid expectation that a meaningful real stimulus may begin to arrive by late March. The pitifully small $600 individual payments from December did almost nothing to restoke the economy. The newly passed $1.9 trillion rescue stimulus will add further to the money supply over the next 60 days, as we shall see in the next months and second quarter 2021 numbers. Traditional precious metals have steadied now. Gold set an interim high above $1,900 an ounce in early January, but failed to push higher and test last August's temporary move above $2,000. Recent action in gold prices show testing of and rebounding from support levels at about $1,700. Silver behaved similarly again during February, moving up and down in the $26 to $28 range. Rhodium moved up again to new all-time high levels as speculators continue to move in strongly, pushing prices past $19,000 per ounce in February, and now, very recently, within the last couple of days, at over $26,000 per ounce. The top is probably being put in at this point. Platinum has now advanced to about double its low, set in mid-2019, and could be the next target for speculation. Month-end prices for gold and rhodium keep our APPM indicator deeply into the red. The January leading economic indicators from the Conference Board again improved slightly, and for this report, our APLI indicator stays at yellow now for 3 months in a row. We still expect lackluster LEIs to continue during the next few months. The Conference Board also continues to warn of a weak recovery and that we should expect a weak economy well into 2021. Nevertheless, if these slight increases each month continue, we will be back in green territory here in about 30 to 60 days. Our APYC yield curve indicator continued green for 2 months, the first time since May of 2018. The yield curve is moving all on its own towards a more normal shape, with the short end firmly anchored near 0%, but the long end up well past 2% for the 20 and 30-year treasuries. This is indicative of a bit more confidence in the economy near term, with increased demand for borrowing virtually interest-free in the short terms. Long term, this is not a sustainable paradigm. Should any other potholes occur in the road to recovery, the Fed now has little room to do anything on its own with interest rates to further stimulate. If inflation pops up, as well as a further expansion of the equity bubble, the Fed may be forced to react, raising short-term rates, which would likely collapse the bubble. The Federal Reserve's weekly aggregate measure of economic stability remains in a position of relative safety, but the Fed itself has stayed with the NBER declaration of recession within all of their data sets. Fed charts for other data that we observe clearly show they have not cleared the bottom of the recession from their data sets, and Recession 2020 is now 11 months in extent per the NBER and the Fed. Therefore, our APFD indicator for this report remains red now for 10 straight months. This may change shortly. Because as the third quarter 2020 GDP grew substantially upwards from its enormous decline in the first half of 2020, the traditional measure and definitions of recession have already indicated a technical end of Recession 2020. Neither the NBER nor the Federal Reserve have yet to take official notice of this technical end. However, advanced projections declared it earlier that Recession 2020 had ended, approximately 8 months after it began, which puts us back in November of last year. But we do maintain a cautious stance here. The root cause of the massive collapse that characterized the onset of Recession 2020 has not gone away. The economy is still much weaker than it was in January 2020 before COVID hit our shores. Now, just past a large third wave, COVID variants still have the potential to spread rapidly during this spring. Control of this situation will determine if there is a second GDP dip and perhaps a recession 2021. Real-time events will determine this, as the majority of our standard set of indicators have not yet returned to green states. We expect them to do so very slowly over many months. We will have to basically rely on a direct watch of public health statistics, unemployment figures, GDP, velocity of money, and financial stability indices for several months, which are inherently less reliable short-term indicators of recession potential. So in summary, only 2 of our 6 indicators are in green territory, and we reflect that in our slightly lowered probability of another near-term recession to 70%. We calculated that the actual onset of recession had already begun just over a year ago, a fact that was then confirmed by the NBER in June of last year, and it became officially acknowledged by the Federal Reserve later in the summer with the adoption of NBER's declaration within the Federal Reserve datasets. However, as we just noted above in bold text, the technical end of Recession 2020 has already occurred late in the third quarter of 2020. We maintain that this is a very risky equity market environment, with the potential for significant and protracted drops, or with a flash crash based upon the disparities shown in our charts this month. Only those with the highest tolerances for risk should be speculating in the equities markets at these levels. High speculative valuations never persist, and a return to the mean or worse becomes more likely with any new unexpected disruptive influence. The only moderating influence in this scenario is that the Federal Reserve has continued to state a longer-term near-zero interest rate environment, and that tends to fan the fires of market speculation. This situation could persist for a couple of years, or some new, perhaps unexpected black swan event could arrive to pop this bubble in short order. What we continue to ponder here at AP is the economic setup for the 2020s, the entire decade. Is it possible for history to repeat itself, looking back at the 1920s, in that we could expect to experience another roaring 20s, as public confidence, optimism, and spending take over once COVID is truly behind us? Despite the glossy economic reputation of the 1920s, there were 3 recessions in it before the big one, the Great Depression? Will a more responsive and proactive Fed and a hands-on administration change our prospects? Well, that's it. Thanks for listening. We know this is a longer report. They keep tending to grow, but we're glad that you've stuck with us this long, and we hope you find these valuable and informative. We'll talk to you again at the beginning of April. Thanks a lot.